Hey, it's Soleil, and this is episode 118 of the Orange Pill Investor. And today I want to talk about, uh, well, since I've been talking about finally becoming work optional, I guess it's developed quite a bit more interest than my average post. So I guess people just hate their jobs as much as I do. And so I'm kind of starting to fantasize about what my quitting is going to look like. I'm probably going to milk this job until the end of 2025-ish. So, do I just quit same day? Do I do like Brett Favre told the officials one time when he told them that they should just take 2 weeks off and then quit? I I'm starting to put together a bunch of scenarios, or do I just do the standard 2 to 4 weeks notice, or do I just stop working and wait for them to to get rid of me, to fix the glitch, as you might say. But really, you know, finally becoming work optional wasn't necessarily easy. Selling covered calls and selling puts is very simple, but when I started trading in May of 2020, I just dove headfirst into just hundreds upon hundreds of tasty trade videos. And there's a channel called In the Money on YouTube, and I watch tons of his content as well. He's probably one of the best teachers of options that I've ever seen. Just the way he explains things, just it's just easy to understand. And so hopefully I can save some people the trouble of having to watch hundreds of hours of videos if I can just distill it down into what worked for me, and maybe you can make it work for you, or maybe not. Maybe you'll figure out a better way to do it. But I've gone over the mechanics of the trade. You sell a put um, below the current share price, and if you get assigned, you sell a call above the share price. That's pretty easy, but a lot of people will ask, how do you decide what to trade? And so the way that I got started is completely different than what I do now, but they were both fairly effective. I just think my way that I do it now is kind of easy mode. It's definitely less time intensive. But what I used to do is I used to log in every morning to Market Chameleon, and then I would go to the implied volatility rankings, and then I would generally sort by implied volatility. High options prices tend to be correlated with high implied volatility rankings. You can also sort by the 52-week, and this worked. And I was just a premium hunter. I didn't care the fundamentals. I mean, I traded GameStop back in the day, even though it's a useless piece of shit company. I even, I made a couple of mistakes where I was just like, oh, there's tons of implied volatility here, and I would start trading it, and then I would check the news, and I'd be like, oh, Budget or Enterprise or somebody is like in bankruptcy talks, and so here I am trading this stock that could declare bankruptcy at any minute. So, but then I got to the point where I would just do a cursory news check, and as long as they weren't like in bankruptcy talks or bankruptcy risk, I would just trade it. So I was completely agnostic. I didn't check the fundamentals. I didn't check the chart. I really just didn't care. I was just hunting premium, and I was getting, sometimes 5-10%. When GameStop was doing its thing, I could get like 5% easy every week, trading some of those options. But this was very time intensive. So like I would have to get this ticker and then I would load it up and I would look at it. Does it have weekly options? And just because it has a high IV doesn't mean that necessarily that the options premium will be any good, but it was just the only indicator that I had to go on. And so I might check 10 or 20 of these before I get weekly options with good premium. Some of these names are still here from a couple of years ago when I was trading this. Oxygen sounds familiar. Yeah, the COVID vaccines used to be in here, and a lot of the other EV companies not named Tesla were here. Actually, Tesla used to make it to this list, but their premium has become kind of disappointing lately. So that's one way to do it. You can be completely agnostic. You can just go hunting premium, and you're kind of more diversified that way. I used to trade, I might have 10, 15 different stocks, and I would sell puts in all of them, or if I was assigned on the other half, I'd have sell calls in them. And I might add to the position, so I might have 500 shares of whatever, weed stocks, like Tilray and some other stuff. So I might have 500 shares of this and just 100 shares of something else. If I was selling covered, I might be selling covered calls and selling puts at the same time. So back then I was diversified in a bunch of different names. I was diversified in multiple strategies. I might be diversified in multiple days to expiration. Usually I would go for weeklies, but if there was something that was a lot of premium, but it only traded monthlies, every once in a while I would just throw one of those in there. And I even dabbled with like some dividend stocks. I'm like, okay, well, if I get assigned, then I'm going to own them. I might as well own them through dividend day, and that never really impressed me too much. But the point is, if I checked the premium and it was like 3%, 5%, I'm good to go. I'm trading it. Don't care about the fundamentals, don't care about anything else. Since then, I don't know if it turned to the dark side of the force or whatever, but at some point I became completely orange-pilled and kind of just turned on to the fact that Bitcoin is the apex predator in the financial space. And just like I listened to hundreds of hours of Tasty Trade videos learning how to trade options, after listening to hundreds of hours of Michael Saylor interviews, I became convinced that the asset that you want to own has two properties. One, it's disrupting. So think Apple when they came out with the iPhone, Nokia, and the other phone makers that were on top all got disrupted. The horse and buggy when Ford started churning out Model Ts. Netflix disrupted Blockbuster. GPS disrupted and dematerialized Maps. And Bitcoin is dematerializing store of value. So everything that people used to store physically, like gold, real estate, fine art, things like that, Bitcoin is dematerializing. It's a better store of value as a digital commodity. So property number one, it's disrupting. Property number two, Saylor said, was it's the clear winner. So you wouldn't have wanted, just because Facebook and MySpace were dematerializing and basically making everyone engage with each other virtually, doesn't mean that MySpace is a winner. If you invested in MySpace instead of Facebook, you probably got screwed. So you have to know who the clear winner is and invest in them. And again, Bitcoin fits that bill. They have been at the top of coin market cap forever. They got the first mover advantage. There can only be one proof of work network that basically wins the race, and proof of stake is inferior, and even worse than that, it's, as far as I'm concerned, it's an automatic red flag for scammy shitcoin status. So there's no second best to Bitcoin. And so I trade Bitcoin derivatives like MicroStrategy and mining stocks. The mining stocks that I selected are based off of how much premium I can get, but also their liquidity. It has to be very easy to get in and out of a trade, and the bid-ask spreads have to be very tight. So for HUT, the mid price on this is 9 cents, and people are bidding 8 cents and asking 10. So this is a 2-cent bid-ask spread. This is what you want to see. What you don't want to see, and why I stopped trading it, is CLSK. Because on these cheap stocks, you're not really collecting a lot of premium. CLSK's premium is pretty legit, and that's why I was trading it. However, anytime it trades in increments of a nickel, I feel like I'm getting screwed $2 or $3 on every trade. $2 or $3 to get in, $2 or $3 to get out. Now, when you're making $100, and this is for only 3 days, that may not seem like a lot, but it's basically throwing away. If you pay $3, if you get screwed for 3 on the way in and on the way out, that's 6% of $1. So you're basically throwing away 6% of your profits. And it would be even worse. Like if HUT was only going to pay you $20, and you only got paid 15 because the mid price was 18, and you had to go all the way down to 15 to get a fill. That pisses me off. So I dumped CLSK and picked up another 100 shares of Mara in this account, and the other one that I trade is Riot. So Saylor's criteria is what made me land with Bitcoin derivatives, and also Tesla. Tesla is disrupting gas car companies. They're disrupting the energy industry. They're disrupting Uber and rideshare with robotaxis. They're disrupting basically everything that they touch. They're going to be disrupting the human labor market when there's billions of humanoid robots doing manual labor. They're the clear winner. Everybody's looking for the next Tesla. They want to buy something that's $5 a share and hope it goes to $500 a share, whatever. That's not going to happen. I mean, you can get some pumps or whatever, but there's no second best Bitcoin. There's no second best Tesla either. So if you're looking for the next Tesla, it is Tesla. The competition is not coming. And like BYD is actually legit competition, but their margins are shit compared to Tesla. So it's like they're still kind of like their annoying little brother. They have a good products. You can't argue against some of their products, but they're not pumping them out with insane margins like Tesla is. So Bitcoin derivatives and Tesla are the only assets that I own. The premium on Tesla lately kind of sucks, so that's annoying. But the upside is so good, I just kind of can't help it. But yeah, so this is another one. So it cost you $10 to buy 100 shares. Could turn around and collect, 24 bucks at the money. I would never sell that close, but I sold the 12s when the price was probably 11. So I'd make about 10% callaway value in it. Let's check the liquidity. So 400 people bidding, 163 people asking. That's what you want to see. Shit ton of open interest, tons of volume. You want to be able to open the trade and not get screwed on the bid-ask spread. This is a penny apart. That's perfect. And you want to be able to exit the trade as well and not get screwed. You cannot make money if you can't get into a trade and get out of the trade, both. So this is how I select stocks now. I used to be completely agnostic. I traded anything and everything. If it had a ton of implied volatility, if it had a ton of, just for shits and giggles, I'm just going to check my old friend GameStop. When they were doing the short squeeze, I made a little bit of money. I was selling puts, so I didn't make nearly as much money as people did when they were just buying long calls and YOLOing their fucking life savings. But, wow. So the premium on GameStop is kind of insane. Like, I usually try to get at least 1%, up here somewhere. But 1% of this would be 16 cents. This is like 10% almost. And it's only 3 days to expiration. So you probably could have gotten 10% returns for the week. But the problem with freaking GameStop is it was down to $10, and it could be $10 next week. So you might make $1.50 on $1,600 worth of collateral, but then that collateral might only be worth $1,000 next week. So that's what you're dealing with GameStop. It's kind of a zombie company. I can't imagine that this company will survive. Do they still have chains, or I don't even know. They've still got stores. Okay, yeah, they're effed. This is probably, like, this chart is just disgusting. They did the short squeeze, and from them it's just down and to the right. That's what this is. So I probably wouldn't touch this with a 10-foot pole at this point, but back here I was probably trading this, and I would sell puts here, and then I would get assigned, and then I would sell the calls, and then when those got called away, I would just get the fuck out of the trade. I'm not going to, it pumped to here, and it, to me, it was clear, like, once the short squeeze was over, like, okay, that's the end of that. And so, once you get a good bounce, it crashed to 27, then it bounces to 41, you gotta cut bait at some point. You cannot just be like, oh, okay, I'm going to buy in at $50 a share and then just ride this all the way down. That doesn't make any sense. So back in the day, I would have traded this. I'd probably sell a put, get paid $1, 10% almost, and keep it moving, and then just try to get out at some point before it crashes too hard. But it's not worth it, really. There's too many stocks with good fundamentals. So now I only trade stocks I believe in. I wouldn't trade GameStop to save my life at this point. I believe in Bitcoin, so I trade Bitcoin stocks. I believe in Tesla, so I own and trade Tesla. Oh, yeah. So I guess I've waited this long to talk about it, but for me, the secret sauce that I guess I kind of came up with it on my own. In all the videos I've ever seen, I've never really heard anybody else talking about it. But for me, the secret sauce is reinvesting the profits. And once you are reinvesting enough of the profits that you're able to set up an additional covered call every week, Now your profits are not additive. So if you're collecting 1% premium a week, that's 52% ROI for the year. That's great. That's amazing. That's how I went from, that's one of the ways that I went from, thinking I was going to work every day for the rest of my life to being, basically work optional, and I'm planning my exit strategy. But the real secret sauce is when whatever the cheapest stock you're trading, and for me right now that's HUT. When you get to a point where your premium is at least enough to buy another 100 shares, so if the premium you collect every week is at least $819, then you can purchase another 100 shares of HUT, and then you can go back in and sell another covered call against HUT, or you could sell a cash secured put from HUT and instead of buying the shares. Completely fine if you're running the wheel. It really makes no difference. And the reason why that's important, and I kind of like, as far as I'm concerned, it's the secret sauce for really amplifying profits, is because now your profits are not 1% a week. They're 1% plus 1% of 1%. And the calculation totally changes at that point. So before, you'd take 1% and you'd multiply it times 52, which would give you 52%. That's the easy math. But compound interest, the formula is, if you're making 1.01, so you're making 1%, you start with 1.01, and you raise it to the exponent of however many times you're going to compound it. And in my case, I sell weeklies, so I compound this 52 times every Friday. And instead of 52% a year, it's 67%. So that's a huge gain every year. And let's just, it just keeps going. So if you did that for 5 years, and you're gonna, 252 times 1.01 raised to the 250th. You do that for 5 years, you're going to 10x your money. That's where it's at as far as I'm concerned. There could be faster ways to earn money, but they're damn sure not this simple. And they're definitely not this safe. A lot of people say that selling, options is scary, and they've, dipped their toe in it and they got wrecked, trading options. And I'm not sure if these people were buying options or selling them or whatever, but something happens and it leaves a bad taste in their mouth. But for me, because I'm selling a covered call, or if I'm selling a cash secured put, I'm basically reducing my cost basis every time I do that. So I'm getting a discount on the stock. I'm buying my stocks cheaper than everyone else in the market. And to me, that's an advantage that can't be overlooked. And if you get 1% premium every week for 100 weeks, your stock is free. You've basically paid for the stock, and it doesn't matter if it's $8 HUT or $1,200 MicroStrategy. If you get 1% a week for 100 weeks, now you own that stock free and clear, and you literally paid nothing for it. So whatever its value is at that point, it's free. Your cost basis is zero, and the stock can go up, down, whatever it wants to do, and you're basically 100% profit at that point. So it's safer than buy and hold because it has downside protection. The trade-off, of course, there's always a trade-off. It's not a get-rich-quick scheme. The trade-off is maximum upside. So like here, if you were selling covered calls at like 250 or something here, and then it goes to 10, where you're going to make the $50 from 2 to 250, and the other guy on the other side of your trade is going to make $750 when it goes up to 10. And if that if that pisses you off and you're not going to be able to sleep at night just because you didn't make as much money as the other guy, then yeah, maybe this strategy is not for you. But this doesn't bother me in the least, because now, it pumped to 14, and now it's kind of settling into the 6 to 10 to 12 to 11 to 7 range. So I'm happy to sell, when it's here, I can sell the 8 or the 9. Okay, it went to 10, that's fine. I made $200, the other guy made $100. That's a win-win for me. And then, just because somebody else makes more money on the trade than I did does not affect my psychology whatsoever. Any winning trade is a good trade. So, but yeah, that for me is kind of the secret sauce. So, I mean, everybody talks about reinvesting profits, but when you're reinvesting it in this way, the returns become exponential. They become calculated by raising this exponent to the number of expirations that you choose, which has actually got my attention a little bit, because SPY actually does daily expirations. The premium that you can get on it is terrible, but the fact that I could get 250, like I looked at it the other day and it was like literally 1.001. Whoops, that's too many. 1.001. I think it was like a tenth of a percent, but you can do that 252 times a year. So yeah, I mean, it's 28%. That's still better than the market does. But there's tax implications. I'm not a tax advisor, and it's not financial advice, but I guess you'd have to pay taxes on the 28%. So I don't know if that bothers some people. If making more money bothers you, I guess that's a concern. All right, I think that's it for now. This is how I did it, and it's how I'm going to keep doing it. And that's all I got for today. All right, be good, y'all.